Okay. So can you tell me what is investment appraisal?
Yeah, so investment appraisal is basically to check if it's worthwhile to invest your funds into a particular project.
And to do this, there are some techniques which is called what?
Yeah, so there is a average rate of
They are called
sorry,
investment appraisal techniques. What are they called?
yeah, investment appraisal tech.
What does the investment appraisal technique tell you? How many
Tells you
investment appraisal techniques do you have basically?
four of them: accounting rate of return, payback period, net present value, and internal rate of return.
Okay, fine. So accounting rate of return is concerned with
Accounting profit.
accounting profit. How do you calculate the ARR?
Yeah, so you will take the average profit and
Average annual profit over the life of investment
average profit upon average investment. Yeah,
into 100. Okay.
yeah, into one.
So the accounting rate of return is basically concerned with the profitability.
Hmm.
Okay.
Yeah,
But okay, when you are doing an investment, are you more interested in the profitability, or are you interested to know whether the money that you have invested is going to come back?
yes.
What are you more interested to know?
You're more interested to know the profitability.
No, see, when
Waiting
you
payback
invest
period.
in a project, okay, whenever you invest anything in a project, okay,
Yeah,
you will first thing that you want to have is you want your initial expenditure, initial
yeah,
investment that you have done, you want that to come back.
yes.
This should be your first concern, that you want your initial investment or your initial investment to come back. After that, you will look at the profitability. So they say that more
Yeah.
better than the accounting rate of return, another method of investment appraisal technique is called the payback period. What is it called? Payback period.
Payback period.
Payback period will tell you that within how much time your initial expenditure is going to come back. Okay, your initial expenditure or your initial outlay that you have done on the project, within how many years that cash will come back. Afterwards, you can look for the profitability, because having a good cash flow is more important than having profitability.
Yeah,
Okay, so the payback period tells you that your business is only at risk till the time you have not got back your initial expenditure.
yeah,
Once you have recovered all your money, then afterwards, whatever you're doing is something which you can see later on. But the payback period tells you the time over which your business is at risk, and you will want to be at risk at the least number of years. So the payback period
yeah.
is concerned with cash flows. What is it concerned with?
Cash flows.
It is not concerned with profit. Payback period tells you the earlier you recover your investment, the better it is. So if you have a shorter payback period, suppose you have a project A and project B. Project A would give back your investment in 2 years, and project B would give you back your investment in 3 years. Both the projects are giving you back your investments. So, in which project would you invest? Which project is more beneficial?
Um, A.
A. The project which has a shorter payback period will always be preferred over a project which has a longer payback period. Are you with me?
Yeah, yes.
Can you tell me what do you mean by net cash flow?
Cash flow is the cash inflow minus the cash outflow.
So does your net cash flow ever include the non-cash expense?
No.
No. So you remember that now we've discussed two methods of investment appraisal technique. Your first method was your accounting rate of return, which was considering
Yeah.
profitability as a measure of find as a measure of making a decision whether to invest or not. If your ARR was more than your return on capital employed, then you can invest. Am I correct?
Yeah.
Payback period method is looking at what?
I
It
was
is
looking
not
at the cash
looking at,
flow.
it is looking at cash flow. And
Cash
what does
flow.
this method tell you?
Sorry.
What does this method tell you? It
It
tells
tells
you
you
the
your
earlier you recover,
the better
the better. The earlier you recover what?
return
Cash.
on
The
investment.
earlier you recover your cash, the better. It tells
Okay.
you that the business is only at risk till the time you do not get back your money. Once you get back your
Yeah.
money, your risk is over. So the
Yeah.
payback period is basically concerned with what?
The
Cash.
cash flow.
It tells you the earlier you recover your money, the better.
The better.
Okay. Now, when you're doing the payback period method, you are only concerned with three things. Okay. Your profit and depreciation will never come into your calculations. Non cash expenses will never be considered when you are doing the payback period. Are you with me?
Yeah.
We will be only concerned with cash coming in,
Cash coming in
cash
and going out.
going out. We are not concerned with sales. We are not concerned with purchases. With me,
Yeah. Yeah. Yeah, miss.
you should always remember what does ARR assess? Profit.
ARR is the profitability
What does
and
payback period?
payback cash flow.
Cash flow. So when you're doing the payback period method, you have three steps. First step is you will calculate the net cash flow. What do you mean by net cash flow?
Cash inflow minus cash outflow.
Then you will calculate the cumulative net cash flow. First, you will calculate the NCF, the net cash
NG, net cash
flow.
flow.
Okay? Then you will calculate the cumulative net cash flow. And after that, you will calculate the number of years that you will take to recover your money. The number of
Yes.
years that you will take to recover the money,
Recovery.
or you could say you will calculate the payback period.
Okay. Payback period.
Let's see. First, CF, net cash flow, then CNCF, that is cumulative net cash flow. Let's look over here. Profitability depreciation to be avoided. You're only concerned with cash coming in, cash going out. Are you with me?
Yes, miss.
Okay. Let's answer the first question. This is a past paper question of October, November 21, paper 32. Can you tell me what do you understand by the term net cash flow?
Net cash flow is the cash inflow minus the cash outflow. Total cash inflow minus total cash outflow.
Okay, fine. Okay, this was your first question. Now they are telling you that you have to analyze the above information and calculate the cash flow and cumulative cash flow. That means they are asking you to calculate the net cash flow and cumulative net cash flow. Are you with me?
Yeah.
Okay, fine. How many years do you have? You have 4 years. Are you with me?
Yeah. Yes.
Okay. The question is, can you please read the question? It's a worked example
Yeah.
question.
ABC Limited is proposing the manufacture of a new product that will involve the purchase of new plant costing $100,000.
Okay,
Expected
so
cash for the
you
yeah
are going to purchase a new plant that is costing $100,000. So what is this?
what is
Cash
this as in like
outflow.
yeah
Could say this is your initial investment,
initial investment.
or you could say this is your initial outlay. Are you with me?
Yeah,
Okay, fine.
yes.
Then read ahead.
Calculate the payback period for the expected cash flow are as follows. And to calculate the payback period.
Okay, to calculate the payback period, what is your first step? Net
So
cash
first you
flow.
the yeah
You
net
have your
net
net
cash
cash
flow.
flow. Okay, how do you get the net cash flow?
Cash inflow minus cash outflow.
Okay, now you have 4 years. One is your year one, year two, year three, and year four, right? Correct?
Yeah, miss.
You will add by yourself year zero. What does year zero say? This is your year in which you are making your initial investment. Okay?
Yes.
In the
Yeah.
year zero, you have your initial investment of how much?
100,000.
$100,000. So, in the first year, when you're making your initial investment, you have a cash outflow of $100,000. Your net
Yeah.
cash outflow is $100,000, and your cumulative net cash receipts is also $100,000.
$1,000.
Okay. Then you have your receipts. So you can just pick up your receipts and you can put it.
Yeah.
Okay. Year one, two, three, four.
Yeah. Miss.
And you have your payments. Similarly, you can just take your payments and put it in year one, two, three, four.
Yes.
Okay. Your payments you can put in bracket or however you want, it does not matter. So you will get your net cash flow. Can you tell me your net cash flow?
Uh, 30,000 for the first one.
Hmm.
40,000. 50,000 and 46,000.
Now cumulative. When you say cumulative, you are going to add it. Now how you're going to do it? This is your initial outflow, right?
Yeah, miss.
Okay. You are going to get back 30,000 in year one.
Yes.
So at the end of year one, how much amount
Hmm.
is still left to be got back?
Um, how much amount?
In year zero, you
Hmm.
have invested
Okay, so to
100,000.
subtract the.
Yeah.
Okay, fine.
You got back 30,000. So at the end of year one, how much is still left to be received?
Yeah, so minus 70,000.
At the end of year two,
Minus 30,000.
at the end of year three, now you've
20.
already
It's
recovered
20.
all your investment,
Sorry, only
and
20,
now
not
you are in
minus.
a
Yeah,
positive figure of 20,000.
20,000.
And now you are in a positive figure of 66,000.
Yeah.
So your full investment is going to be recovered between year two and year three.
Yes.
Are you with me?
Yes, miss.
Now you have to calculate the payback period. So can you say that the payback period is between year two and year three?
Yeah, yes.
Say that the payback period is between year two and year three.
3, yeah.
Okay, fine. So when your cumulative net cash flow turns from
Mm-hmm.
negative to positive, that means you have recovered your full
Yeah.
investment.
Yes.
Okay. Now, how do you calculate your payback period? Tell me.
Uh,
Think.
First, sorry.
See, at the end of year two, can I
Uh,
say that at the end of year two,
yeah.
30,000 was still required to be recovered?
Yes. So
I will
it's
say
that.
at the
Hmm.
end of year two, 30,000 is still required to pay back
Yeah.
investment. Yeah, tell me.
Yes. Yeah. So 30 at the end of year two, still 30,000 is negative.
Yeah,
So maybe at the end of year three is the payback period.
but you have to give exact months.
Oh, wait, 1 second.
So
So
this
exact marks.
30,000, can I
Uh,
say, this 30,000 I will recover in year three?
yeah, in 12 months.
Okay, in 12 months. So it took me 12 months. In 12 months, I will be earning 50,000
In 12 months, we'll be earning 50,000.
here.
Yeah,
See, at the end of year two, 30,000 was still required to pay back the investment.
yeah.
Yes. This 30,000 I will recover in year three.
Yes.
In my year three, that is the period of 12 months, my net cash flow is 50,000.
Mm-hmm.
So
Yeah,
for in entire 12 months, I will be earning 50,000. Cash flow will be 50,000. So
yeah, 50.
30,000 would be
Mm-hmm.
recovered in how many months?
30,000 in how many months?
So
1 second, huh?
30,000 will be recovered in how many months? Sorry, cross multiply. 30,000 into 12,
20, no? So
30,000
you
into 12 divided by 50,000.
you'll do 1 year and 8 months. So 20 months would be 1 year and
How,
8 months.
how?
Cross multiply, no?
30,000 into 12 divided by 50,000.
Oh, 7.2.
Calculate 3 into 12 divided by 5. So 7.2.
12 in 12 months, 50,000 was earned. So in
Yeah, so
30,
30,000,
how
will be
many
earned in
months?
how many months?
How many months? Yeah. So 7.2.
7.2 months. That means your payback period is, can I say my payback period is 2 years plus 7.2 months?
Yeah.
Okay, but there is nothing that is called 0.2 months. It is 7
Yeah.
months and 20 days. So can I say it is 2 years,
8 months.
8 months?
Yeah.
Okay,
Yeah. Okay.
okay. What is very important is that you understand this part.
Yeah. Got it. Yes.
Okay, I hope you've written
Yeah.
it. If you want, I will pause it
Yeah.
and you
Miss.
can write it.
I've written it.
Yeah, your investment will be paid back when?
Uh, 2 years and 8 months.
2 years and 8 months. Now, come on. I have another question over here where I have two
Hmm.
projects. Can you see? I
Yeah.
have
Yeah. Mm-hmm.
project one and I have project two.
Yeah.
Are you with me? Can you tell me
Yes.
the initial outlay or the initial expenditure for my project 1 and project 2?
Mm, cost, you mean?
Yeah. Initial cost,
80,000.
initial outlay, initial expenditure means the same thing.
80,000.
80,000. So 80,000 is the initial expenditure for my project 1 and project 2. Correct?
Yeah, yes.
I have been given net cash inflow for project 1 and project 2 both. Are you with me?
Yeah,
Can you
yes,
tell
miss.
me my project 1, in how many years will I recover my initial outlay?
Project 1.
5, 6, 7. If you see, my inflows is 80,000 for project 1,
Hmm.
and my inflow for project is also 80,000. Are you with me?
Hmm.
Can you
Yeah.
tell me the payback period for project 1?
Hmm. 1 second. Just 1 second. Hmm. 3 years. No,
3
wait.
years. Yes.
Yeah, 3 years. Yes.
Because it is taking me 3 years to recover the entire 80,000. Yeah?
Yeah,
Okay. Can you tell me the initial outlay for project 2?
80,000.
Can you tell me the payback period for project 2?
3 years.
3 years. That means 1, 2, and 3. It is taking me 3 years to recover the entire initial investment. Now,
Yeah,
the question over here is both the projects have the same initial outlay. Yes?
yes.
Both the projects have the same payback period.
Yeah, so which one to choose what,
Which
right?
one to select? Project 1 or project 2?
Two,
Why?
because net cash inflow is higher.
Because in the initial years for project 2, you are getting more cash flow. Okay?
Yeah,
So which project to select? Can you write along with me which project to
yeah,
select?
yeah.
Project 2 is more attractive as the cash flow is better in early years.
Yeah.
Okay? Now, can you give me the advantages of ARR?
Yeah, easy to calculate and understand. Um, it includes it takes into account depreciation.
Okay, very good.
Mm,
Advantages
disadvantage,
of payback period.
payback period advantages, straightforward to calculate,
You can
and
also write
cash.
easy to calculate, and it
Yeah,
compares the risk of different projects. What does it
com
compare?
the
Risk.
risk of different projects.
What does the payback period tell you? You are at risk till when?
Cash flow.
No. What does
Uh,
the payback period
that's
tell
good.
you? You are at risk till when?
Till when, um, till when your this thing is negative, your
You are at
acute
risk only till the time you recover your
your expert.
initial investment.
Yeah, that
Okay. Payback period tells you that you are at risk only till the time you recover your initial investment. So, what is the
investment.
advantages of payback period?
Yeah, so payback period is easy to calculate, and it compares different risks with different
It
projects.
compares the
And
risk of different projects.
yeah,
What is the
and
disadvantage of payback period?
disadvantage would be projects with
Disadvantage.
uh, life expectancy of project is ignored. Yeah, so they do not take into consideration the useful life of the project.
So what do they take into consideration?
Only net cash inflow.
They take into consideration only that much time till when you're going to recover your initial investment.
Recover. Yeah, yeah,
Okay?
yes.
And what is the other disadvantage?
Projects with same payback period may have different cash flow, like the sum above we did. Yeah.
Yes, yes, yes. So now you have an activity 39.2. I want you to do this activity.
Okay.
Okay. You have two systems. One is system A and one is system B. And they have already given you a format in which you have to prepare it. What do they want you to calculate?
The payback period for each computer system. So A
And they
and
want
B.
you to state with reasons which computer
Mm-hmm.
system should you purchase.
Purchase.
Now
Fine.
here you have a column of net cash flow. So when
Mm-hmm.
they say you net cash flow, what are you going to do?
Yeah, so inflow minus outflow.
So what is the net cash flow for system A?
So 20,000.
Now are you going to write direct 20,000 or you're going to add in year zero?
Sorry, you're gonna put this thing.
Year zero.
That. Oh wait, for cumulative, we'll just add the
You
amount.
will
So
not put the
50,000
year zero. Why will you put year zero? Because you have to show the cost of your initial investment.
initial investment.
Why are you going
Yes,
to show year zero?
because you need to show the cost of your initial investment.
If you had inflow and outflow both, you would have shown it in the outflow column. But now you've
Yeah,
not given you inflow, outflow both. They've given you net cash flow directly. So
net
that
cash
will
flow.
not
So
put
yeah, to
anything.
show only cumulative. Huh?
Okay, you'll just show in cumulative. Now,
Yeah, yeah.
the net cash flow for system A. So it will be 80 minus
20,000
60, 20
for again 20,000 and 40,000.
for system B,
30,000, 20,000, and
20,000,
25.
20,000
20,000 and
and
25.
70 minus 45, 25,000. Okay. Now, can you give me this cumulative? What will you do?
Yeah, so minus 30,000,
Minus 30,000, then
minus 10,000,
minus 10,000,
positive 30,000.
positive 30,000. Okay. Here.
Here again minus 20,000,
Hmm.
then 0,
Hmm.
25.
Positive 25,000.
Yeah.
So your investment,
Hmm.
which computer system should you purchase?
Yeah. So 1 second.
For system A, can you give me the payback period? Your investment will be recovered between,
1 second. Between the year 2 and 3.
can we write it together?
Yeah, fine.
Investment will be
Mhm.
recovered between
For A now we have to do.
year 2 and 3. Then what will you write?
Then you'll find
At
the
the end of year 2,
Mine negative 10,000.
10,000 is
Yeah.
still required to be paid back.
Yeah.
This 10,000 will be recovered in which
In
year?
one year.
In year 3.
Yeah. Okay. Yeah. In year 3 years.
Then what will you write?
1 second. No?
It takes 12 months to recover how much?
Net cash. 12 for
30,000.
40. 12 for 40. How much for 30,000?
So 30,000 will be recovered in how many months? So
Hmm.
30,000
9 months.
into 12 divided by 40,000. So this will
So
be covered in 9
nine.
months.
So 2 years and 9 months.
So the payback period for system A is 2 years, 9
Hmm.
months.
9 months.
System B,
For B, uh,
1
again invest.
and 2.
Yeah.
So system B, the payback period is how much?
1 second. So in 12 months is 25,000. So
No, darling,
25,000.
see over here, at the end of 2 years,
Actually, it's only two
nothing
years.
is.
Yeah.
So it
Hmm.
is exact 2 years.
Exact 2 years. Yeah.
So system
Yes.
B has a shorter payback period
System B as a, yeah, yes.
by how many months?
By 9 months.
Here you
By
have
9 months.
to give your evaluation. So system B has a shorter payback period by 9 months. Yeah.
Yeah, yeah, yes, miss.
If you want a quicker payback period, so which system should be chosen?
System B.
Okay. But if you want more cash flow, then which system should be chosen?
System, this one, A.
Because system A is at the end of year 2 giving you 30,000.
Yeah, and
And
this is giving
system B is
25
going to
between
give you 25,000.
20.
So
Yes,
if
yes,
you
yes.
want a quick payment method, so if you want
Mm-hmm.
a quick payment, then which method you should choose?
B.
So if you want quick payback, then system
Mm-hmm.
B should be chosen. Please write
Yes.
along with me. Then
Okay.
system B should be chosen. If payback is not important, then
System A.
if
If
payback is
cash flow
not
is, if
important,
you need a higher cash flow at the end, yeah.
then system A should be chosen. These all evaluation will help you when you have to give your advice and when you have a
Hmm.
full-fledged sum. So you should know
Yeah.
what to write.
Yeah. Okay.
And
All right.
calculation of the payback period is very important.
Hmm. Yes, miss. Hmm.
Okay. Now I'll give you
Yeah.
one more sum, which is a past paper. So now this is your mid plenary.
Mm-hmm.
I wanted to do
Okay.
this sum, and you have to
All right.
calculate the accounting rate of return, and you
Mm-hmm.
have to calculate the payback period of machine A.
Okay, fine.
Accounting rate of return and payback period of machine A.
Okay, okay, fine.
Okay.
Mm-hmm. Yeah.
Accounting rate of return and payback period of machine A. Can you do it along with me?
Yeah.
Okay. What is
Okay.
your
So
initial
yeah.
investment?
So it'll be average profit upon
So
average
initial
investment.
investment is how much?
So you'll 950,000.
950,000. What is the useful life of the machinery?
4 years.
Residual value is
Nothing. Zero.
0. When you're calculating accounting rate of return, you will do net
Mhm.
cash flow.
Yeah.
minus depreciation.
Yes.
What is the depreciation per year?
Depreciation is 1 second, 950,000 divided by 4. 237,500.
950,000 divided by 4. So it is
Yeah.
2375.
237,500. Yeah.
Okay, fine, lovely. So we are
Hmm.
calculating accounting rate of return. So first thing that we will see is what? Net cash flow. So inflow
Yeah.
minus
So net cash
outflow.
flow for each year. Huh. Yeah. Yeah. So
So I got
640
my
minus.
net cash flow
Yeah.
for 4 years.
Yeah.
What is the total net cash flow?
Total net cash flow is 1 second,
Okay,
400, 200, 800, 1,100.
no, 1,000,
Yeah.
100,000.
Yeah, that only. Yeah.
Okay. What is my depreciation for the 4 years?
Depreciation 237,500.
So
So
it
you'll
is
subtract that from it.
7500. So at the end of 4 years, it will be the full cost of investment 950,000.
237,500 into 4. So 950,000.
Okay, so
So
what is my
um
profit?
11,000
Profit
minus
profit for the life of investment
1 second, 150,000 dollars. Yeah.
150,000. Now
Upon the
average
useful
annual
years.
profit is how much?
37500. Huh. Uh,
37,500.
yeah, that, yes, got that.
Okay. What is average investment?
Average investment is the cost minus residual value, which is 0
50,000
upon 2.
minus 0 upon 2. So it is how much?
475,000. So
475,000.
37,500 upon 47,500 into 100.
What is my ARR?
7.89%.
So 7.89% is my ARR.
No payback period.
Now payback period. So I will write my net cash flow. I will
Net.
put my 0, 1, 2, 3, 4. Yeah.
Yeah.
And cumulative net cash flow.